Thank you for joining for our Q4 2024 Economic Review. My name is Dave Mantell with Stabler Wealth Management, and in this video we're going to be reviewing 2024 with a zoom in into the fourth quarter, as well as our outlook in 2025 and the year ahead. With that, let's jump into the presentation. So as we do these presentations, our view is knowledge is power. Especially in the current world we're in, where there's so many headlines and information moves so quickly, it helps to have an understanding and grasp on what's happening in the world and how it actually affects your impact and impacts your investments and portfolio. So as we do these presentations, we want to shed a light not only on what's happening, but also what that means to you and how we view that and react accordingly. As we look back at the fourth quarter of 2024, we had a bumpy quarter, but ended in the positive. The S&P 500 ended up just under 2%, and the Dow was just slightly positive at 0.7% for the quarter, capping a really strong year for both indices. As we had some big news headlines in the fourth quarter, specifically the election, you can notice there's lots of ups and downs, but despite that, we ended up capping a 23% gain for the S&P 500, a terrific outcome. And the Dow also was positive at up 13% for the year. These are nearly identical returns to what we saw in 2023 for both indices, resulting in a really rare occasion for the S&P 500 where we logged back-to-back 20% returns. As we look at the underlying components of the economy and the markets, inflation has been a key headline for the past couple of years. And as we look at the end of 2024, inflation ended at a level of plus 2.9%. While we've seen some really steady progress from the high 9% plus levels back in 2022 into 2023, this decline that really picked up in the early 2024 year has been a bit more stubborn as of late. While 2.9% inflation is about the same range we've seen for the past several months and has even ticked up slightly, it's still in a much more normal level than from what we saw, in those peaks in 2022 to 2023. And so in total, it's a decent number. And what that means is while 2.9% inflation is quite a bit ahead of the Fed's 2% target, it basically allows us to have the flexibility for cutting rates, for different support of the economy as needed, versus when you're in that 7, 8, 9% range, your hands are pretty tied. And so overall, it'd be great to see some more progress on the inflation front, though at a much more acceptable level from what we saw in some of the prior years. Whenever we look at inflation, it really goes hand in hand with interest rates. It's hard to talk about one without the other. And so after the Fed started with a 50 basis point, so 0.5% reduction rates back in September, they cut rates again twice in the fourth quarter of 2024, resulting in 3 rate cuts in total for 2024. While that does feel like progress, that's much less than the 7 anticipated rate cuts going into the year for 2024 that many investors were anticipating. And so while being at that 4.5%, 4.25% interest rate level is progress from the 5.5% we saw at the peak in 2024, it's still historically a bit more of an elevated level, from the past 10, 15 years especially. And so it'll be one to really watch what that tracks to in 2025. The current expectation is with stubborn inflation like we talked about, and the economy hanging in there pretty good and really being resilient, it's likely that we're going to see limited rate cuts, if any, throughout the year. And the Fed sort of indicated as late, they're going to take more of a wait-and-see approach to see how the economy holds up, what the overall markets do before determining future rate cut policy. So this will be a key item to watch along with inflation as we trudge ahead into 2025. So while there's a lot of commentary and really anxiety over higher interest rates, between higher mortgage rates, costing companies more to borrow, costing the government more to borrow, the positive of higher interest rates is you get much better bond income for your safer, income-oriented investments. And so as you can see on this chart here, even between January of 2024 at the start of the year and December, although the Fed started cutting rates, we've seen longer term interest rates and therefore longer term bond yields increase throughout the year. And so as you can note, a 10-year Treasury bond, so a 10-year US government bond, at the beginning of 2024 was yielding just under 4% income. At the end of 2024, that was up to about 4.6% income. And so even though the Fed has started cutting rates, we've seen longer term interest rates continue to creep up. This is a bit unique. A lot of times when you think about the Fed cutting rates, you'd expect interest rates across the board would come down. Something to note though is we've had what's called an inverted yield curve for a number of years. And basically what that means is short-term interest rates have been higher than longer-term interest rates. And so with the short-term rates going down and longer-term rates going up, while that feels counterintuitive, basically what's happened is we've come back to a bit more normal of a yield curve, which again means when someone's loaning money for 5 years or 10 years or longer, they are getting a higher return versus loaning money for a shorter time. Which generally makes sense, right, for committing to that longer period in a sense. And so while it feels a little backwards seeing longer term interest rates increase, the flip side of that is we're getting into a little bit of a more normal interest rate regime. And it does really benefit investors where your safe income-oriented investments are earning a much higher income, which is a really big deal, especially for retiree investment portfolios. And so all in all, there's absolutely worries with higher interest rates, but that is one silver lining, earning that higher income on those bond investments. So with that, as noted in a prior slide, in a really solid, high quality bond portfolio, we're seeing about a 5% interest yield, 5% income. And when you compare that to the price yield on the stock market, which basically says for the current stock market prices, what percent are the profits or underlying company earnings relative to where the stock market's priced. And so generally speaking, the bond income yield is lower than the stock market earnings yield. And because of that is with a bond, you have more fixed known income payments, right? It's more of a termed, contracted income level. While with the stock market, there's a lot of unknowns and variance there. And so generally bond yields are lower than those stock market earnings yields. In this case, as we've seen bond yields go up and the stock market go up, so prices have gone higher, we've actually seen bond yields surpass those stock market earnings yields in recent months, which is an indication, one, the stock market feels a bit elevated based on that metric, but also bond income is quite attractive versus what it's been for the past several decades. And so again, that's an exciting thing for bond investors. We're earning that nice income in your bond portfolio. I will note on this slide the S&P 500, so the stock market earnings yield. This is different than dividends. This is basically saying with all the companies in the stock market, what is their profits relative to the price of the market, not how much dividend income are they sending out. And so with that earnings yield, much of that money is being reinvested in companies, going into additional investment. And so just did want to clarify, so that is different from the dividend level, but again, an indication that bonds are priced quite attractive in this current interest rate regime we're in. So as we take a step back, there's a lot going on in the world. And I think if anything, there's a very high likelihood that 2025 is going to be a volatile year. And what that means is it doesn't mean the stock market's going to go down per se. What it means is we're going to see, likely some sizable swings, both up as well as possibly down, as the stock market and the economy digest all the various news headlines. So as we go through a new president and a new regime in that regard, there's going to be a lot of unknowns regarding, tariffs, tax policy, what does the Fed do on interest rates? We've seen a lot of geopolitical tensions as late. Do we see more escalation and de-escalation? And so there's just a countless number of headlines to be tracking. And what this does is create a lot of unknowns and anxieties in the market. Many of these headlines are going to be positive for the market. Some of them are going to be less so. And as we were mentioning late in 2024 going into the election, the first year of a presidential term tends to be a positive year, especially as you have that uncertainty of who the next president is going to be determined. And so it is good to note, though, there's a lot going on. And so even if we do end up seeing a really positive year, which is very possible, it's unlikely that it's going to go up in a straight line. We're likely going to see some ups and downs, peaks and valleys along the way. Again, this is very normal, but it's helpful just knowing going in that this is to be expected and likely going to be part of the course for 2025. And so let's hope we have a smooth upward line, right? But again, with all the headlines going on, information, how quickly things digest, there's likely going to be a lot of, again, positives and some temporary setbacks in the market, which we see just about every year. And so as we look forward into 2025, many headlines to keep an eye on and track as we think about market performance going forward. So with all that in mind, the question stands, will this bull market continue? What are the prospects for the stock market for 2025? And so as we kind of list out the pros and cons, there's a lot of elements in both the positive as well as the more unknown ledger on the balance sheet. So for one, we've had really resilient economic growth. As we hit on earlier, the fact that inflation has normalized to more normal levels, and despite the Fed raising interest rates so dramatically and not cutting that much to date, we've seen lower unemployment rates, strong earnings growth. That bodes really well for the economy. So despite many of the headlines, the worries that we were talking about, when you look under the hood of the economy, things are surprisingly solid despite all the different curveballs that's been thrown at it. And so most importantly, that's really positive to see, a strong economic foundation that we can then build off and hopefully see market results off of. On the flip side, while there's a lot of positives in that regard, stock market prices are quite elevated. And even if you have strong earnings growths and the economy's humming and doing well, there's a price and a value for everything. And so that is a concern and something that we're absolutely focused on, is just from the current stock prices, the current values of the company, how much room is there to run? And what's that look like? And so with that in mind, even though we tend to be quite optimistic on the performance of the underlying economy, that can limit stock market performance based on a lot of the price gains have already happened. And as we look at another component, which has sort of been a standing bullet for the last couple of years, is there's a lot of geopolitical and policy and political risks out there. Between wars and tensions abroad, what happens in Ukraine, what happens in tensions with China, where do tariffs land, how does that impact the economy? Beyond that, does deregulation go into effect? What do taxes do? There's many different ways and directions that are going to help shape the output of what happens. And so, again, this is something for us to keep our eyes on and be mindful of, but this can really whip around and change, month to month, period to period. But something that's always going to be on the backdrop a bit, given the, headline heavy world that we're currently living in. So as we break this down, as I mentioned earlier, rare occurrence where the S&P 500 logged two back-to-back 20% returns in 2023 and 2024, coming off of a tough 2022. This is a really rare occurrence. As you can see, going back to the 1800s, there's only been 10 times where we've seen back-to-back 20% performance of the S&P 500. And so that's out of 150 or so instances, right? Taking that a step further, this is only the fifth time going back to the 1950s, so 70 years, where we've seen the S&P 500 log back-to-back 20% years. And as we looked at year 3 and 4 after those first two positive, tends to be more lukewarm, mediocre results. We've had a couple periods like the 1990s where the party continued, right? And the music kept on playing. But more common than not, you'll see some down years mixed in there or some, kind of lower gain years. And so every year is different, every situation is different. But again, it's an indication that when you get such strong performance back to back, prices tend to be a bit elevated, and that leaves a bit less performance in the short term, more commonly than not. The same theme is demonstrated on this next chart here. And so basically the value of the stock market is determined by what are the profits, what are the earnings that those underlying companies are earning or generating. And so on this chart, this looks at how expensive is the stock market based on the underlying profits or earnings and comparing that to returns over the past, 27 or so years. So this goes back to 1988 and looks at 10-year stretches. And so the first one would be, 1988 to 1998. So that ended 27 years ago. And then 1989 to 1999. And based on the starting price to earnings report, so again, how expensive the stock market is, this is an indication of how the next 10 years performed per year on average. So as you can see, that gray bar, we are more on the far right end of this chart. Again, indicating based on the recent run, stock market prices are more elevated than they typically have been. The little dots indicate when the stock market's been priced at those levels, what's the performance been over the next decade. And you can see the performance has been much more tepid at this range. Generally speaking, between, -2 and +2%. So nothing to write home about there, right? Nothing too exciting on that front. And so that would be an indication, again, at the current elevated prices, there's less room for price appreciation going forward, even if we had a stronger economy. I do want to indicate the S&P 500, so that's the stock market indicator demonstrated here, the composition has changed quite a bit over the years. And so if we went back to, the 1980s, for example, much less technology. It was much slower growth, industrials, financials, those types of industries made up a higher proportion. If you look now, about 30% of that stock market is more technology, high flyers that tend to be more growth oriented and tend to trade at a more expensive price point. And so that makes it so it's not completely apples to apples. Nonetheless, when you find yourself kind of looking to justify charts like this, that is a demonstration that, we're likely at more expensive, elevated prices, no matter which way you cut it. And so this is something that we're really, being thoughtful of, going forward. With that in mind, there's a lot of stock market categories that are priced much more attractive. This chart on the right here shows dividend stocks remain pretty cheap relative to the S&P 500. I could show you the same chart for small and mid-sized companies, global companies. And so the good news is there's a big map of various investments that we could invest in. And so while the S&P 500, large US technology-based companies are a key component that we're going to want to continue to hold, we are able to buffet that with a lot of different categories that can be complementary. The other thing I want to mention too is even though prices are elevated, that could continue for a long time. I could show you essentially the same chart back in 2019, and while we've had lots of ups and downs and volatility the last 5 years, it's been a really solid 5-year performance run nonetheless. And we're going through, some changes in terms of the amount of inflation, money in circulation, government debt, things like that. And so it's important to be mindful of these charts. This by no means, is a call that the stock market's going to be down this year. Rather, it's just an indication that it's good to take a step back and realize after a couple good years run, prices are a bit more elevated. And so it's good to be a bit more selective and thoughtful as we're investing and allocating your portfolio. Now, while I provided a little bit of a bear case right there. Not to make anybody nervous. On the flip side, we have really strong economic momentum currently, much of this led by AI. And so basically, despite the last couple of years of constant calls for a recession, we have yet to see one. And we've actually seen economic growth ticking up to about 3% or so in the US, which is a really solid number. Beyond that, earnings have been strong. There's an expectation for a 15% profit increase this year, earnings profits increase, which is a really great number. If we do see, continued low taxes, again, that will bode well, more likely than not for the market. I talked about worries of tariffs. On the flip side, if we do see deregulation, that could help there, especially for, certain categories. And so, again, we do believe that we are on quite solid footing despite everything going on in the world. And on the AI front, again, it's very exciting. I personally believe, going back to the internet, this is probably the next big technology wave from there. And with that in mind, the initial forecast is this could have nearly $2 trillion impact on the economy and the markets. Historically, economists have tended to undershoot the economic impact of these huge, monumental new technology advances. And so it could absolutely be higher than that. I will note, studying this over the past many months, really our view is that the best way to participate in this AI wave is that it is going to benefit all companies, right, in general, or general companies. And it's going to basically, raise that, performance and profitability and, economic output level across the board. And so, we likely view most, market companies would benefit from this. It's really tough to say, well, is ChatGPT the investment theme, or should we be, buying more chips companies? Because as technology changes so quick, it's hard to know who the winners are going to be and who the losers going forward. But the exciting thing is, as we see all these AI advancements, we do believe, again, it's going to, kind of rise that level across the board and benefit companies as they're able to use it. And so, again, we have strong momentum in that regard. The economy's been solid. So while there are worries of elevated prices, we do see a lot of positives in this regard. So as we sum it all up, 2024 was a really solid year for the stock market. Again, the S&P 500 was up over 20%, being a bit more tech heavy. The Dow was up 13% again, a really good level. The Fed cut rates 3 times in 2024, less than initially anticipated. However, the economy has stood up pretty well despite that. And we'll see going forward. Again, I think the Fed's going to take a bit more of a wait and see approach. We might see a couple rate cuts. They have that in their back pocket if needed to bolster the economy. But, as inflation's been a bit more stubborn, hard to make a call that we're going to see, another, big round of rate cuts anytime soon. Inflation, while it's been stubborn, it has normalized, right? Stubborn inflation in the 2% is a lot better than stubborn inflation in the 8-9% level. So I do think that's a positive. And while 2025 brings a lot of unknowns and different headlines that can create uncertainty in the market, we do have really strong market momentum, and under the hood, fundamentally, things are pretty solid, but prices are elevated, right? And so again, it's one of those proceed with caution. This is a great time to review your investment mixtures. You're getting paid well on your bond investments. And so there's not a need to stretch for risk or put your neck out there. We've had some great performance these last several years, last couple of years coming off of 2022. And so again, really important for everybody to, review their portfolio versus their comfort zone versus their cash needs. A great time for balance. We're hopeful that we'll have a good stock market year, but there's a lot of unknowns out there, right? And so it's really critical to have an all-weather strategy as we do for our clients to make sure that we're able to get through these periods like 2022 and then enjoy the other side once we get there. And so keeping that long-term perspective is critical. And we are here to discuss questions or concerns that you have. again, we are going through very uncertain times. And so it is anybody human is feeling uncomfortable here and there, right, with everything going on. And so we are always here as a sounding board, and we'll continue to strive to make sure your investments match your goals and comfort zone there. So we really appreciate you all. Thank you for tuning in on this. Just mentioning, we'd love for you to join our Client Ambassador Club. Most of you we've met through introductions of friends, family, people you care about that we've probably worked with over the past, 20, 30 years. And so as you know of people that you think can benefit from meeting with us, that you think can get value out of a conversation, we'd love to talk to them and see if we could help. So please make an introduction. Works really well. If you have email works good, you can make an introduction to them and us, your advisor here. But love to help anybody you care about that you believe can benefit from talking to us. So that all sounds good there. We're going to keep these economic updates coming as well as other workshops. We have an exciting one coming up in April on cybersecurity, a really important topic these days, right? Especially how fast technology is moving. So we'll have more information on that. And if there's any themes or areas of interest, please share that. For those of you that are not current clients, go to our website. There's a big orange button at the top right that says Let's Talk. That'll go right to my calendar, and I'd love to talk with you and see where we could help out or provide feedback. So make sure to jump on the website and do that. We'd love to have a chance to meet with you and see where we could assist. So thank you again for your time. It's much appreciated, and reach out with any questions. Take care.